Most people dive into the stock market and lose money, not because it's hard, but because they skip the basics. What are the core principles every beginner must know before investing a single penny? And why do so many first-timers fall for common traps that could have been easily avoided? In this audio summary, we will break down the absolute fundamentals of the stock market, from how it works to what you really need to start investing with confidence. Have you ever thought about investing, but felt overwhelmed by charts, jargon, or the fear of losing money? You're not alone, and this is exactly where you start. By the end of this audio summary, you'll have a crystal clear understanding of how the stock market works, and you'll be ready to take your first step without fear or confusion. If you're new to this channel, don't forget to hit the subscribe button so you never miss an update. And be sure to leave a comment letting us know whether you're a trader or an investor in the stock market. Imagine this. You're walking down Wall Street in New York City, the financial epicenter of the world. The air hums with energy, the buzz of commerce weaving its way through the streets. The New York Stock Exchange looms ahead, a beacon of wealth and opportunity. Traders hustle, screens flash numbers at lightning speed, and billions of dollars change hands in a matter of seconds. But what exactly is happening here? What is this world so many are eager to enter, yet find so complex and intimidating? Welcome to the stock market, the heartbeat of modern capitalism. It's not just a place where people buy and sell shares. It's a dynamic arena where ideas meet money, risks meet rewards, and where fortunes are both made and lost. If you've ever asked, how do people make money from stocks? Or, why do stock prices rise and fall? Then you're already at the starting line of this incredible journey. The stock market, at its core, is a marketplace where investors trade shares of ownership in public companies. These shares, known as stocks, represent a claim on a company's assets and earnings. The basic premise is simple: buy low, sell high. But the reality is a thrilling blend of psychology, economics, politics, and strategy. It's not just about numbers, it's about narratives, belief systems, and timing. To truly grasp the stock market, we need to rewind time and understand its origins. The modern stock market traces its roots back to Amsterdam in the early 1600s, where the Dutch East India Company issued the first shares to the public. Fast forward a few centuries, and the United States would become the epicenter of global financial markets. The New York Stock Exchange was founded in 1792 under a buttonwood tree, when 24 stockbrokers signed an agreement that would change history. Today, it's part of a sprawling digital network where anyone with a smartphone and a trading account can participate. But let me ask you something. If investing is such a powerful way to grow wealth, why doesn't everyone do it successfully? The answer lies in knowledge, patience, and emotional discipline. The stock market is not a get-rich-quick scheme. It's a long-term commitment. Think of it as planting a tree. You water it, nurture it, protect it from storms, and in time, it bears fruit. There's a quote by Warren Buffett that perfectly sums this up. The stock market is a device for transferring money from the impatient to the patient. These words hold immense weight, especially in an age where instant gratification rules. Successful investors are not those who panic when prices drop, but those who see the bigger picture and stay the course. Let's take Sarah, for example. She's a 28-year-old marketing executive based in Chicago. A few years ago, she decided to start investing. Instead of jumping in head first, she spent time learning the basics, understanding how companies are valued, what financial statements mean, and how global events affect markets. She started small, investing in companies she believed in, like Apple and Microsoft. Over time, her portfolio grew, not because she was lucky, but because she was informed, disciplined, and patient. Contrast that with Jake, a 35-year-old who followed stock tips on social media without doing any research. He poured his savings into a hyped-up biotech company after a celebrity endorsement. The stock soared briefly, then crashed. Jake panicked, sold at a loss, and swore off investing forever. The difference between Sarah and Jake was their mindset and education. Before we dive deeper into the mechanics of the stock market, here's a question to ponder. What kind of investor do you want to be? Are you in it for the thrill, or are you building something for your future self? The answer will guide your journey more than any chart or forecast. Remember, the stock market is a reflection of human emotion as much as it is of company performance. Greed, fear, optimism, doubt, they all play out in the ticker tape. Understanding this emotional landscape is just as important as reading financial reports. As we continue this journey together, keep an open mind. Don't be afraid to question what you hear, and always seek to understand the why behind the what. Investing is not about knowing everything. It's about making informed decisions with the information you have and continually learning as you go. In the next chapter, we'll break down the types of stocks and how they behave in different economic climates. We'll also explore what makes a company valuable and how you can spot potential winners. Whether you're dreaming of early retirement, a safety net, or financial independence, this journey into the stock market is your first powerful step. When you first look at the stock market, it can feel like staring at a massive menu in a foreign restaurant. Every option seems unfamiliar, and you're not sure where to begin. But like any good menu, once you understand the categories, making choices becomes far easier. Stocks, too, come in various forms, each with its own characteristics, risks, and opportunities. Let's start with common stock, the most familiar type. When you hear about people buying shares, this is usually what they mean. Common stock gives investors ownership in a company and typically comes with voting rights. More importantly, it gives you a claim on the company's profits. These profits may be paid out as dividends or reinvested to grow the business. Then there's preferred stock. It's a bit like a hybrid between stocks and bonds. Preferred shareholders get paid dividends before common shareholders and often receive fixed dividend rates. However, they usually don't get voting rights. Think of preferred stock as appealing more to those seeking steady income rather than explosive growth. But that's just the tip of the iceberg. Stocks can also be categorized by the size of the company: large cap, mid cap, and small cap. These terms refer to a company's market capitalization, or the total value of its outstanding shares. For example, companies like Apple and Amazon are considered large cap stocks. They're typically more stable, but they may not offer the same growth potential as smaller firms. Take Tesla as an example. In its early days, it was a small cap stock with massive risk and massive potential. Investors who believed in Elon Musk's vision and stayed the course saw their investments multiply many times over. But with that growth came wild price swings, regulatory hurdles, and constant public scrutiny. That's the trade-off between risk and reward. We also have growth stocks and value stocks. Growth stocks belong to companies expected to grow faster than the market average. These companies often reinvest earnings into expansion rather than paying dividends. Think of tech giants like Nvidia or Meta. Value stocks, on the other hand, are like hidden gems, often undervalued by the market, but with strong fundamentals. Warren Buffett, for instance, built much of his fortune on value investing, famously buying stocks that were trading for less than their intrinsic worth. And let's not forget about dividend stocks. These are typically stable, mature companies that pay out a portion of their profits regularly to shareholders. Utilities and consumer goods companies often fall into this category. For someone looking for passive income, dividend stocks can be a reliable choice. Imagine receiving quarterly checks simply for owning shares in Coca-Cola or Procter & Gamble. That's the power of dividends. Each stock type offers a different experience, and your choice should align with your personal goals. Are you looking for rapid growth, steady income, or perhaps a balance of both? Your risk tolerance, time horizon, and financial situation all play a role in shaping your investment strategy. Now, here's a question to reflect on. If you had $10,000 to invest today, what kind of stock would you choose, and why? Would you chase the high-flying tech company promising to change the world, or the boring but consistent utility company that pays a 4% dividend yield? There's no right or wrong answer, only what fits your unique journey. In the next chapter, we'll dig deeper into how companies are valued. We'll explore tools like price-to-earnings ratios, book value, and earnings reports. It's not about becoming a finance wizard overnight. It's about gaining enough insight to make smart, confident choices. Because at the end of the day, investing isn't about predicting the future, it's about preparing for it. Disclaimer: this chapter is a bit technical and may be confusing for an absolute beginner. Therefore, I would recommend listening this chapter 2 or 3 times for better understanding. Let's say you walk into a store, and on a dusty back shelf, you find a rare baseball card. It's priced at $100. Now, you wonder, is that a good deal? You check online marketplaces, talk to collectors, compare with similar items, and realize it might actually be worth $300. That's value investing in its purest form, buying something for less than what it's truly worth. Valuing a company is very similar. It's not about guessing which stock will double next week. It's about assessing what a business is truly worth, and then deciding if the current stock price reflects that value. One of the most fundamental tools in this process is the price-to-earnings ratio, often referred to as the P/E ratio. The P/E ratio measures a company's current share price relative to its earnings per share. If Company A has a stock price of $50 and earnings per share of $5, its P/E ratio is 10. This means investors are willing to pay $10 for every dollar of current earnings. But what does that number tell us? A lower P/E might suggest a stock is undervalued, while a higher one could indicate growth expectations or overvaluation. But numbers don't tell the whole story. Context is everything. For example, a tech startup might have a P/E of 100, which seems absurd until you realize they're growing revenue at 80% a year. On the other hand, a P/E of 10 for a retail company might seem like a bargain, until you learn that it's been losing market share for 5 straight years. Then there's book value, essentially the value of a company's assets minus its liabilities. If a company were to shut down and sell everything it owns, how much would be left for shareholders? Comparing a stock's market price to its book value can offer insight into whether it's overpriced or undervalued. Some value investors look for companies trading below their book value, seeing them as overlooked opportunities. Another key metric is earnings per share, or EPS. It tells you how much profit a company generates for each outstanding share. Strong and steadily growing EPS usually signals a healthy, profitable company. But be cautious. EPS can be manipulated through accounting tricks or share buybacks. Always dig deeper. Let's not forget cash flow, often called the lifeblood of any business. A company can report profits but still run out of money if it doesn't manage its cash well. Free cash flow, the cash left after capital expenditures, is a strong indicator of a company's financial health. Investors love businesses that generate consistent, growing free cash flow. Think of Apple. Its vast cash reserves and steady flow of earnings give it tremendous flexibility. Now imagine two companies. Company X has booming revenue, exciting products, and tons of media buzz, but it's burning cash and taking on debt. Company Y grows slowly but steadily, with consistent profits and a fortress balance sheet. Which would you choose? There's no one-size-fits-all answer. It depends on your goals, risk appetite, and time horizon. Valuation isn't only about crunching numbers, it's about telling a story. What does this company do? Who are its competitors? How does it make money? What are its growth drivers? What could go wrong? Great investors are also great storytellers. They weave the data into a coherent, believable narrative. Howard Marks, a legendary investor, once said, "You can't predict, you can prepare." That means understanding not just the upside of a stock, but the risks as well. A company might look perfect on paper, but faces regulatory threats, competitive pressure, or shifting consumer trends. Consider Netflix. For years, it was a darling of the stock market. But as competition from Disney+, Amazon Prime, and others intensified, investors started reevaluating its growth prospects. Suddenly, the narrative shifted. Even with strong subscriber numbers, the stock dipped because expectations had changed. This is why valuation is both art and science. You need the math, yes, but also the imagination to envision where the company is going. It's not just about where a stock has been, but where it's headed, and whether the price today reflects that potential. So here's something to ask yourself the next time you look at a stock. If this company were a private business you could own outright, would you still buy it? If the answer is yes, you're starting to think like a real investor. In the next chapter, we'll explore the economic forces that influence stock prices, interest rates, inflation, GDP growth, and how the Federal Reserve's actions ripple through the market. If you've ever wondered why markets react so dramatically to a single speech by the Fed chair, you're about to find out. If you're enjoying the video so far, don't forget to give it a like and drop a comment with the word stock market. That way, we'll know the kind of topics you're interested in, and we can create more content you'll love. Picture this. It's a regular Wednesday morning. A press conference is scheduled, and the chair of the Federal Reserve walks up to the podium. Words are chosen carefully, every syllable scrutinized by millions across the globe. The statement is barely a few paragraphs, yet within minutes, the stock market surges or plunges. Why? What just happened? Welcome to the fascinating world of macroeconomics and its enormous influence on the stock market. You see, behind every ticker symbol lies a network of larger forces: interest rates, inflation, employment data, and GDP growth. And at the heart of it all, particularly in the United States, is the Federal Reserve, often called the Fed. Let's start with interest rates. When the Fed raises interest rates, borrowing becomes more expensive. That affects everyone, from massive corporations down to the person financing a new car. For businesses, higher borrowing costs can mean delaying expansion, cutting back on hiring, or shelving new product lines. All of that impacts earnings and earnings drive stock prices. On the flip side, when rates are low, it's like stepping on the economic gas pedal. Companies can borrow cheaply, consumers spend more, and the economy grows. This often leads to rising stock prices, as investors anticipate higher corporate profits. Here's a real-life example. In the aftermath of the 2008 financial crisis, the Fed slashed interest rates to near zero to stimulate the economy. The result? Over the next decade, the stock market experienced one of its longest bull runs in history. Companies like Amazon, Apple, and Google exploded in value, helped in part by easy access to capital and rising consumer demand. But interest rates aren't the only player. Inflation is another powerful force. It measures the general increase in prices over time. While moderate inflation is a sign of a healthy economy, too much can erode purchasing power, shrink corporate margins, and spook investors. Let's say you run a restaurant and the cost of ingredients suddenly rises by 20%. Unless you raise your menu prices, which might drive customers away, your profits take a hit. Investors know this, and when inflation spikes, they tend to get nervous. Stocks, especially those with tight margins, often take a hit. So what does the Fed do when inflation rises? Typically, it raises interest rates to cool down the economy. But therein lies the delicate dance. Raise rates too fast, and you might trigger a recession. Move too slowly, and inflation spirals. It's a balancing act, and markets hang on every cue. And then there's GDP, gross domestic product, the broadest measure of economic activity. Strong GDP growth usually means companies are doing well, consumers are spending, and confidence is high. All of this is good for stocks. But if GDP contracts for 2 consecutive quarters, we're in a recession, a word that can send markets into panic mode. Employment data also plays a crucial role. The monthly jobs report in the US is watched globally. If more people are working, that usually means more spending, more demand, and potentially more inflation. If unemployment rises, fear grows about slowing demand, shrinking profits, and weaker corporate performance. It's like a giant web where everything is connected. A war in Eastern Europe affects oil prices. Oil prices influence transportation costs. That, in turn, impacts retail companies and airline stocks. Suddenly, a geopolitical event on the other side of the globe moves your portfolio. This interconnectedness is both the challenge and the beauty of the market. But despite all this complexity, there are ways to prepare. Legendary investor Ray Dalio talks about the economic machine, a system of credit cycles, productivity, and spending. His core message? Learn how the machine works, and you won't be surprised when it breaks or roars back to life. Think back to March 2020, when COVID-19 shut down the world. Stock markets crashed, uncertainty skyrocketed, and panic ruled. But just months later, despite rising case counts, the market rebounded strongly. Why? The Fed slashed rates, injected liquidity into the system, and the government passed stimulus packages. Money flowed, and investors bet on recovery. Understanding the logic behind these moves gives you an edge. You don't need to predict the next recession or market boom. But when you hear that inflation is rising, or the Fed is tightening monetary policy, you'll know what it means for your investments. And here's something to keep in mind. The market isn't just reacting to today's data. It's always looking ahead. It prices in expectations. So if bad news isn't as bad as feared, stocks might rise. If good news isn't good enough, they might fall. It's not just about the facts, but how those facts compare to what was anticipated. Now that you've learned how the stock market works, how companies are valued, And what macroeconomic forces move markets? The big question is, how do you actually begin? The truth is, getting started with investing has never been easier. But that doesn't mean it should be done without careful thought. Let's imagine you're sitting at your kitchen table with your laptop open. You've saved up $1,000. You're ready to invest. The first step? Opening a brokerage account. This is your gateway to the stock market. Many countries have online brokerage platforms that allow individuals to open an investment account within minutes. These platforms, both traditional institutions and newer fintech apps, make it easy to start trading or investing from virtually anywhere. But wait, what kind of brokerage account should you open? If you're investing for retirement, you might consider an IRA, either traditional or Roth. These accounts come with tax advantages that can boost your long-term returns. If you're investing for more flexible goals, like buying a house or starting a business, a standard taxable brokerage account is the way to go. Once you've opened your account, it's time to fund it and decide what to invest in. This is where many new investors freeze. The sheer number of choices, stocks, ETFs, mutual funds, index funds, can be overwhelming. So let's simplify it. Active investing means picking individual stocks and trying to outperform the market. Passive investing, on the other hand, involves buying into broad market index funds and holding them over time. Think of the S&P 500. It tracks 500 of the largest companies in the US, from Microsoft to Johnson & Johnson. When you buy an S&P 500 index fund, you're essentially buying a slice of the entire American economy. For many people, passive investing is a solid starting point. It requires less time, less emotional energy, and historically has outperformed most active investors over the long run. There's a famous quote from billionaire John Bogle, founder of Vanguard. Don't look for the needle in the haystack. Just buy the haystack. But maybe you want to dabble in stock picking. That's perfectly fine if you do it wisely. Start with what you know. Love Starbucks? Use Apple products daily? See crowds at Costco every weekend? These everyday observations can be the spark for smart investments. But remember, liking a product isn't enough. Dig into the financials. Understand the company's business model. Know who their competitors are. And most importantly, understand your own risk tolerance. Can you sleep at night knowing your stock might drop 20% tomorrow? If not, you may want to focus more on stable, dividend-paying companies or ETFs. Younger investors often take more risks, knowing they have time to recover. Older investors might lean more conservative, seeking income and preservation of capital. Another essential concept is diversification. Don't put all your money into one stock, one sector, or one country. Spread your investments across different industries, asset classes, and regions. This reduces risk and cushions your portfolio during downturns. Think of it like building a balanced meal. You wouldn't eat only dessert or just salad. A mix keeps things healthy. Let's revisit Sarah from Chapter 1. She started with index funds, added a few blue-chip stocks she researched thoroughly, and made sure to rebalance her portfolio once a year. When tech stocks surged, she didn't get greedy. When markets dropped, she didn't panic. Over 5 years, her portfolio steadily grew. Compare that with Jake, who jumped from stock to stock based on TikTok trends and Reddit posts. He bought high, sold low, and lost confidence in the market. The difference wasn't luck, it was mindset, strategy, and discipline. One more piece of advice: automate your investments. Many brokerage platforms let you set up automatic deposits and recurring investments. This approach, called dollar cost averaging, means you invest a fixed amount regularly, regardless of market conditions. It takes emotion out of the equation and helps you build wealth steadily. Investing isn't about timing the market, it's about time in the market. As Warren Buffett said, someone is sitting in the shade today because someone planted a tree a long time ago. Before we wrap up, let's talk about goals. Why are you investing? Retirement, a house, college for your kids, financial freedom? Your goal will shape your strategy. Write it down, revisit it, let it guide your decisions. And finally, keep learning. The market is always evolving, and so should you. Read books, listen to podcasts, follow trusted financial experts, not the loudest voices, but the most thoughtful ones. Make learning a lifelong habit. The stock market isn't just for Wall Street insiders or tech geniuses. It's for everyone willing to learn, stay patient, and think long term. You don't need to be perfect. You just need to start. And you've already taken the most important step, educating yourself. Your journey is just beginning. Keep asking questions. Keep making smart decisions. And remember, the future belongs to those who prepare for it today. If you enjoyed the video, be sure to give it a like and let us know in the comments what topic you'd like us to cover next.